Hello, ladies and gentlemen, and welcome back to a special weekend edition of the markets around the world. We'll be discussing stocks, commodities, and cryptos today, but specifically looking at the jobs number and what the Federal Reserve has been saying about these markets right now. Now, the jobs number came out on Friday, and the initial reaction was, as we anticipated, the wrong way. Then we usually get some kind of big move, and that's what happened, except this time it was kangaroo style. In fact, the SP500 was moving 2% plus each way through this news. Clearly the market is confused, and probably a lot of you out there are. But today we try to demystify the market using the history, plus on top of that, the macro, and of course some similarities that we've had before with previous fall-offs and pickups. The big thing that I saw in the markets over the last couple of days was realistically commodities, because they started flying, and that's a very interesting thing. Welcome back, everybody, to the Daily Show. We'll start off with the jobs numbers, the macro data, then we'll lead into the charts and the key lead indicators we need to be watching right now, plus the levels that we think are most important. Let's discuss everything to do with these markets right now, specifically the jobs. And really, it's all about the fact that the jobs numbers finally showed potential weakness in the US economy. Now, you might think, well, why would we want to see weakness? It's kind of what the market wants. The market wants to see the unemployment rate go up. And I've got some stats around why that is moving forward. Really, the big thing from 2020 to now has been that all the jobs have come back, plus some, theoretically. However, we haven't seen the leisure and hospitality sector coming back anywhere near as hard. And this becomes interesting when we start talking about that sector in just a few moments. Unemployment rate seasonally adjusted, we saw that go up to 3.7%, up 0.2% overall. And the market initially kind of, it seemed like this. It actually said, well, maybe there's some weakness here in the economy. And that's what we're looking for right now. Weakness to show that the Federal Reserve has started to put a slowdown on the demand. Holiday seasonal retail hiring was slightly down on the last 2 years. Now, this is interesting because, of course, we talked about leisure and hospitality. November tends to be a bumper month of these holiday retail seasonally kind of hiring jobs. Will we see that again? Look at the numbers last time. Look at, of course, the slower hiring here in comparison. Potentially the market makers were looking at this number. But what I like to think is it's also about this. Now, we already know that the US has inverted. In fact, we are already most likely in a recession. The thing is, recessions are overblown because by the time they say the word, yes, we're in a technical recession, or yes, it's happening, usually the market has already come out. In fact, that's statistical that the market has already come out of those points. So why are we thinking unemployment's important? Well, unemployment tends to rise from the cycle troughs around 6.1 months before the recession is called. Now, if we know that historically recessions already have the market bottoming and moving forward, that's a very interesting statistic. Now we can lead on to these last two to see whether they're coming through. And that's going to be something that I think might play into potentially being able to find bottoms in these markets. What about bear market macro index spreads? Well, these we have a couple of reads for over time, and we keep getting reads in 2022, similar to 2008, which we're very heavily correlated with. Now, when we get these types of reads, we go into some statistics, and they're not very good for the market. In fact, 1 month, 3 months, 6 months, 9 months later, 9 months being the key, we're very rarely bullish from this level. Now, that's interesting, because most bear markets kind of go between 10 and 18 months. Now, as we know, we're already quite far into it, but we're certainly not 18 months, nor are we 10 months yet into this bearish market. We're only just getting on that precipice of the beginning of the average kind of median levels. Bear market probability models continue to be really high, and the statistic might shock you on this one. Once you keep getting these readings and you keep getting those red dots, although there's not that much history on it, take a look at this. Only 1 in 20 times was the market bullish over the next 3 months. That's surprising. That's actually a very low statistic. 1 in 20 times. So why is the market not down more, you might ask? Well, it looks pretty bad on the surface. We're getting a little bit of weakness coming through here. I think a lot of it has to do with the fact that the market still believes that the Fed is there. We've seen the Bank of England come into what? Well, they continue to buy the pension funds, try to support the economy. We know that there is the Fed behind, the buyer of last resort. In many ways, I think a lot of you would agree that the market probably should be down 15 to even 20% more than it is right now during normal times, but it isn't. Why? This one here. Small traders and big traders alike just continuously pile into puts. It's not slowing. We're just seeing puts continuously getting stacked. And the problem is that the market doesn't really want to pay those out. So what's the most likely scenario moving forward? Well, you can see here that we've got 1972.73 Dow Jones across with, of course, here the NASDAQ over time. And what we'll notice is that there's a lot of sideways action followed by a further sell-off later on, that capitulation fear zone. Yeah, that could be designed to get rid of a lot of options. And later on today, we'll look at the November options because there are so many puts sitting there ready to expire. Are we going into the kangaroo sideways before potentially the market moves down? We'll talk about that soon. We've still got US 30-year 3-month yields, of course, inverting. These tend to only happen when you have very bad pullbacks in the markets. And we do also know that the market has not been going up like normal. Usually tech and consumer discretionary pull markets out from bottoms. This current rally is industrials, energy, staples, healthcare, financials. It's totally different to what usually is happening. It's the old economy versus the new economy. The new economy is sick. The old economy seems to be being bought. And this is meaning that other countries, Australia, the FTSE, UK, DAX, they're doing way better than the US right now because the US's tech is getting beaten down. We've got some compression levels that are almost crazy when you think about it. What's going on here with things like Twilio and some other hyper stocks. 2-year yields tend to peak around 1 to 1.5 months before the end of the Fed hiking cycle, a statistic that I think is worthwhile knowing. And as we know, we are still in a weakness period here for the economies, generally during bear markets. Although this is one of the strongest times of the year, historically, it isn't when you're in a bear market. And as we know, we are because we're over 20% down. Beats versus misses. Yeah, it's not good. 62% kind of sucks. Beats 1,077, misses 671. If this was any normal earnings season, I would say that's a bad number. We should still be sitting around 70%. We're not. So clearly the markets and the companies are starting to struggle. For the earnings week ahead, before we get into the charts, here are the big companies coming out. Plenty of ones that I think a lot of you out there would like. And we start off with like a Palantir, then we go into like Disney, AMC, some of those. And then of course we've got a lot of hyper stocks. So just before we jump into the charts and we look at the key levels that we should be watching right now, I want to say a big thank you to Tiger Brokers, who's the sponsor of today's video. Now, many of you may know that I love this stock, Microsoft. Of course, it's a great stock. And for me personally, it's one of the best in the market, one of the biggest moats, which I always think is a really important investment concept. But the problem is also, it's really expensive, $221 US. For many people around the world, that's just too much money to own one stock. We have seen some stocks split this year, but this one particularly hasn't. So when it comes to owning some of these stocks, maybe you would wish to own a portion of it. Well, you can do that so with Tiger Brokers now, as they're just introducing fractional stocks. And that basically means you'll be able to own with as little as $5 on some of these stocks, a portion of a Microsoft position. This allows you to get access to something that you may previously have not been able to get access to. The other thing that you want to do is also figure out your levels. And of course, one of these things that I always say is setting alerts. Guys, you've got to set alerts. It's a game changer with technical analysis, with realistically fundamental. It doesn't matter what you're doing. Come into the charts, do your analysis, and set an alert. When price gets to the level, then at least you'll be getting that alert. Now, life gets busy. It gets tough out there. And if you miss it, how many of you have missed trades? Put them in the comments down below. I'm sure it's quite a few of you. So if you're interested in finding out more about Tiger Brokers and the great platform they offer, plus along with some of their new fractional share offerings, then of course click on the links in the description down below. And for the Australian audience and New Zealand audience out there as well, fund with as little as 1 cent today and you get an extra bunch of zip stocks and some other special offers. So let's now take a look at the charts and get into the key levels that we need to be watching right now. We'll start off here with the VIX. It continues to drop. A lot of you can't make sense of this. We've got these crazy kangaroo markets, you say, but the VIX is dropping. The volatility index is still high. 24.5 is still a very high number. But to get the VIX higher, we probably need a new low on at least the NASDAQ, if not the SP 500. And of course, this is based on the SP 500 overall volatility and options. We need new lows. Once you're stuck in a range that is known, the market is not freaking out, but it is coming down. And as we know, if we go back through history, this is kind of symptomatic of what we saw here in 2008, where we had that slightly simmering market, which kept coming up to 35. Then it dropped off and then it just exploded with fear as a very serious thing happened, which of course was some companies starting to weaken. A few weeks ago, we started to see some banks showing cracks. We've also not had the peak fear that you usually see, a 45 plus reading. So this is something that we're still looking at, and it's consistent. The market's dropping back down. Potentially one more fear is ready to go. So what happened with the jobs numbers? Well, look at copper. Now, Dr. Copper is often seen as a lead indicator for the economy and health. And copper blew up. It went big, 8% to the breakout to the buy side here on the daily. Now, that could be a bit of a start of a small rally here in commodities. Now, I think a lot of that's got to do with the fact that we also saw interest rates go up. The Fed say we're going to keep rates higher for longer. And effectively, all of these metals started to recover. But usually copper doesn't, because copper shows us the health of the economy. Well, the economy looks pretty weak in general terms. Yeah, we'll look at a few other ones very, very soon. The US 2-year spiked last week, then it dropped back off. But what has remained is very high rates for longer. April 2023, still at 5%-ish. September 2023, still at 5%. This is a big change. Look at the last 2 days of trade. Huge rally here, big issues in the economy. In fact, it's basically the federal funds rate higher for longer. And as we keep scrolling through, we don't really have a cut, even potentially cut, until at least December and most likely more 2024. So this is something that's pretty interesting. We also saw the 10-year not make a new high, which is showing us that the market is starting to smell demand destruction. It's definitely saying the US economy may not be as strong as we once think, because when the 10-year is way lower than the 2-year, that spread between, of course, the inversion ends up getting bigger. And that's not something that you want to see. That's something that's actually quite sick in the economy. What about bonds? What were they doing? Well, high yield had another okay session on it. And I can tell you, even my lead bonds indicator had a pretty good session on it. For whatever reason, the market is starting to buy some forms of risk. Now, that could be that they believe demand destruction's here. What is clearly not happening is everything that has high PE ratios has been sold off. We've got more on that later. I mean, it's wild what's happening there on high PE stocks. If we go over to corporate bonds, again, not very weak here on corporate bonds. Corporate bonds are holding better than you would expect, pretty much in line with the market. We're not getting any lead indications here from both the high yield and the corporate sectors in the bond side. What about the dollar index? Pretty bad weekend. This bodes okay, you would think, for stock markets. Certainly, that's not the type of candle that you generally have followed up with huge bullish action. It's a pretty big compression candle there by the end of the week. And as we scroll down to the 2-hour, we can see it came up to that supply level and rocketed back off it. Now, it ends in effectively demand. So it ends where it could buy up straight away. And this is going to be something that we'll have to watch through the Monday into the Tuesday session. A very important level for the dollar index. I could see it swiping this and potentially actually even moving up. But we have to find out how it moves. This is the zone where dollar buyers could come back in. And as we have been saying, this is consistent with those stats that showed us a sideways dollar index quite a few weeks ago. Yes, it's up. Yes, it's down. But overall, it's starting to go sideways. It's not necessarily terrible for the stock markets. The euro came off the demand zone that we had down here. I guess that's pretty good. We obviously had a few demand zones in the previous session week. We had the reaction off the first one. We obviously didn't really see that much reaction off this one. and there was no sell-off from here, which is important. Effectively, the market didn't come back up, test this and sell off. It just went blitzing through it. And that's why you need an activation step inside of your supplies and your demands. Really important you do that. Euro ends up being in the supply. Previously, it's sold off this level. May still do that. You'll have to look at it. And then, of course, we've got our new high here over on the top end side. Gold showed us some really strong signs. It came off again this low. And gold continuously does this. It's just being bought and bought and bought. I've got some statistics that'll be coming out over the next week, finding out whether the biggest players in the world are actually buying this. Volume's fairly consistent. And this is super important. People have hated gold almost all year. I mean, look at this statistic. It's just terrible. Since March of 22, it's just been down, 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 down. But take a look at the weekly here. That's 1, 2, 3 bullish buy areas for gold. That's all wicks. Very big demand zone. Clearly, there are buyers coming through here. And when we look at other stocks, let's have a look at Barrick here. Check out Barrick on the New York Stock Exchange. And you'll notice again, a new low was taken through the session of last week. Then it rallied back above pretty fast. And it went down, actually went down to the 2020 lows and then found buyers. GDX is pretty similar. We're starting to see a basing formation. Look at this little island reversal here on GDX towards that accumulation side. Big volume going in for commodities across the world. And it doesn't stop with gold. Look at oil. Oil hit perfectly into that next zone, 92 to 93. Now, you'll know, yes, I'm a little bit bearish on the oil in terms of US oil over the months into the next potentially 6 months, even though I know so many people are bullish on it. But yeah, we couldn't deny the statistics looked very bullish, and it just rallied and rallied and rallied and rallied. And now it's hit, of course, the first time here, resistance. Let's have a look at the daily just to show how big a level this is. See, a lot of people will call this now an inverse head and shoulders, left shoulder, head, right shoulder. And if we end up getting that breakout, what could that do for potentially oil? Well, oil could skyrocket. And if oil does skyrocket, it's probably moving up, fairly consistently, you would think, somewhere into that kind of 100 plus a barrel, maybe even the 104 level again, if not plus. So this is going to be a very interesting week for oil. I'll set a little alert above here. That was a big rally across all metals and commodities. You would think that they have a bit of a cool off through the Monday session, but they're back to some critical levels across that board. Especially gold is very, very interesting at these levels. Let's talk about stocks. And I want to bring up Twilio here. Shocking, 34.6% down. That takes us to a price that effectively was almost its IPO price. That's pretty wild. And this is not just one. It's not just like a one-time only stock. We've got things like here, Cloudflare, a company that I once really loved. Obviously, now I'm out of it. But these types of ones, they're starting to get back into those levels. July 2020, this is where we are now. We're going back into these zones of compression. DraftKings, maybe you don't like it, but again, going back to the beginning of where it started. And it's not just these, it's just so many of these stocks. Another one that I was thinking of bringing up was CrowdStrike, another almost darling of the hypergrowth stocks, new lows being formed through the last session. And what this is telling us is that there is a compression here on valuations. The market is basically saying, okay, we're going to stay at higher rates for longer. What tends to do well during those times? And they're not giving anything to tech. They're saying, no, you need to come down. Valuation compression. So we were in a deflationary boom for well over a decade. And now we're going into potentially a stagflation period or even just a higher new norm of interest rates for longer than expected. That's what's showing on the 10-year and everything else. And they're punishing and compressing all of these. But they've got to be getting closer and closer and closer to that fair value, you would think. And they're going to be the sectors that just show explosions once they eventually turn around. Tesla ended up closing at 207, had a pretty bad session actually, coming back down to the lows. I've still got set 180 just in case it comes down there. Again, this is a stock that probably is going to get compressed like the rest of the market. And that was the trend that we saw on the Friday on pretty much the last 2 weeks. but we're back at the demand zone. And for some buyers, they're going to come in and say, well, you know what? I like this level and I believe this is where Tesla should buy off. For others, they'll be patient and waiting for some of these lows that we saw in 21. Tesla been very resilient though. Apple also finding some very big strength here through these lows, some pretty big kind of buyers purchasing up off those zones. There's not really too much to hate about this stock right now. We've got a gap fill that could be around 144. Remember this when we talk about the S&P 500 soon. But if we get a new low that comes underneath this zone, we've got alerts set. And the reason why is because if Apple falls, the rest of the stock market tends to follow. And I think this could be kind of the straw that breaks the camel's back should it find further weakness. It's a very important zone. We'll talk about that once we go to the S&P 500 soon. Let's now look at the Dow Jones versus SPX versus the S&P 500. Another incredible week of outperformance by the Dow. It just shows you again the old economy versus the new economy is just completely smashing the new economy out to bits. The same thing with the DAX. The DAX made a new high. Now, I probably didn't expect this. I thought the DAX might show some more weakness here. But again, it's those older economy stocks coming through as people try to find refuge with their money across the board. And they're dumping a little bit of US dollars and going into some of these industrial stocks. They tend not to sustain. That's the big thing. When we see rallies that are not across the board and they're only in certain sectors, especially not the new economy, they tend not to sustain because there's only so much you can push these sectors up. Here's the Dow just showing again that big supply, the downward trend line, all of these key zones that we've seen before. Very important level here for the Dow this week. If we make a new high, hey, maybe we will see further rallies for the S&P 500. We'll set a little alert here just in case that does happen. We've got to be open to the idea. Now, this is where the sickness is, the NASDAQ. New lows actually closed or basically right on it. And this was where you were going to probably see buyers come back in. Could this be the kangaroo pattern? Remember before we saw that 70s, we have kind of a compression where it does this for a little bit and then all of a sudden it fell off. We've been in the nice sideways. If we rally and then make a new drop, watch out for potential capitulation. That's where the market drops incredibly significantly, incredibly quickly. And that's something that we're still very open to. This is a compression of PEs, of valuations on these companies. And these are some of the biggest. We've just seen that the top 5 stocks, those big tech stocks in the S&P 500, have dropped to less than 20% of the overall market. That's actually probably a good thing. They were like 24, 25%, but we are seeing them start to compress down. Let's have a look at the S&P 500, the real market here. Again, it's come off that first level of supply. Cool, that's nice. And we've seen it drop back down. It hasn't come anywhere near as low, though, as the rest of the market. And what I think was most important last week was we had the high, the low, and the higher high. We then made a lower low, and the market's now sitting sideways. If it comes back up here, there could be some turn points where market shorters come back in. And a lot of people are going to be going bullish off what we saw here on the Friday. And I just don't know whether it's happening yet, guys. I think that there's still more bearish parameters than bullish parameters in this market overall, except for, of course, the options that we'll look at soon. So we've got the high, we've got the low, we've got the higher high, we've got the lower low now over the bigger sector. We haven't quite got underneath 3640, which we'll be looking for if we're bears this week. And we're seeing some recovery now in this market. So we've got kind of like intersecting lines. We've got a supply here that's been taken out. We've seen buyers coming in pretty consistently after the non-farm payrolls number. And we've got some key points that I've highlighted here around that 3820, 3840. Somewhere in here, or even a little bit higher, are where the bears should sit for the week ahead. That's sitting around 3866 and 38 kind of 30-ish zone. These two areas are where if the sellers are going to come in, they need to come through this zone here or this zone here. If you end up getting a new high, it could be very serious. 4100 could be the next zone. And that's mostly to do with options, the 4100 level. I think the market would rather sideways for now, but the bears should sit in these zones. And at this stage, even with the jobs number, the general sentiment here on this market is mostly bearish. Let's now have a look at the options for the week ahead. Where are the big strikes? 360 continues to be an annoying strike here, but again, not much options. Look at that. Open interest only 811,000. Now, when we scroll through to the 18th, which should be the third week expiration, see this 4.8 million. Like, that's not small. This is huge amounts of options. And look where they all are. They all sit on that 360. They're massive here. The 360 is 187,000 puts. As we go down through this level, you'll notice there are even more puts floating all the way around. And they go into the 300s and even the 320s and everything here. Max Pain still sits at 380. This is the week where you do use Max Pain. It will modify moving into it. But I'm going to be watching those 360 strikes. I'd be very interested to know what happens with those over the next week. Still, so many puts, it's going to be hard to push the market super low through this period. So you've got to be nimble and fast. What it's telling you is if you are bearish, which I don't blame you, I can see real reasons for this week being bearish until we break through those levels, then you really need to be basically looking at this from having to be nimble and fast due to the fact there's so many options expiring. Now, where you may not want to be bearish just yet is literally Bitcoin. We saw crypto doing really well. Take a look here at the dailies. Crypto bounced off that level. I had alerts set thinking, okay, if this happens, we're going to go bearish. But the market turned, and it turned pretty heavily. And it's actually going towards that 22,000 to 22,200. It's a big level here for the crypto market. And yeah, I mean, if it reaches here, this could be, again, that turn point. Remember, crypto is going to the right level. The stock market's got a little bit of work to go up to those zones. Could they be synergizing together again? Definitely watch this space. Crypto to 22,200 seems to be the kind of more likely area at this stage. When we take a look at the week ahead data, remember to have your economics calendar out there. Also remember, daylight savings in the US is happening, CAD daylight savings as well. You need to be aware of that if you're around the world. We have so many people in so many countries. Here in Australia, it makes it very tough. You're going to 1:30 a.m. in the morning, US open time. But that's why we still love the US market, so you've got to be around for it, yeah? Let's have a look what else is going on. We've got, of course, politics coming in here, congressional elections. Then we scroll back through CPI data and the core CPI. That's the one everyone's going to be looking at this week, Thursday, 8:30 a.m. Be careful around there if you're a scalper, or potentially have your limit set for the right levels. And then we've got the prelim, UOM, consumer sentiment. These are all key zones that we'll be watching. If you haven't already, come and follow us at FX Evolution. Also join our Discord community, private or public. You can check both out. And remember, if you're interested in finding out more about what Tiger Brokers can offer you, you can click on the links in the description down below. They have a whole bunch of special offers, especially for our Australian and New Zealand audience, which get a bunch of extra free stock as well when you fund with as little as 1 cent. I think it's the zip stocks at this stage. Fractional shares are also there. Remember to subscribe, smash that like button. We'll see you in the next one. Bye for now.